The US oil patch has not covered itself in glory when it comes to governance. Last year we had exposés about Chesapeake, there's been Sandridge, a rather incestuous deal from Freeport. Chris, Hess is the latest. Elliott Management, which is an activist hedge fund, has come out and said it could be worth more than double what it currently is if they did things right rather than wrong. What's the problem and what could they do?
Well, as you say, there seems to be no end to the number of villains in this particular sector. This is a very old family-run firm,
right.
So the chief executive owns 10%. His name, not coincidentally, is Hess,
and
John
Hess.
He's been CEO
He's been CEO
for 17 years. And so one of the problems is that the board is stuffed with incredibly long-serving members, none of whom seem to have any experience outside the company running an oil company.
Right.
So there's a real lack of oil industry depth here. And coincidentally, they also happen to have very strong financial connections with the Hess family, helping to run the charitable board, helping to run the estate of the founder.
So this coziness is kind of something we've seen these other ones. They get a bit complacent, maybe they get overpaid a little bit for their work too, and the CEOs get to do whatever they like, whether it's sensible or not.
Well, the record of underperformance under Hess has been quite staggering, and yet he always figures in the top quintile of pay in the sector, which seems extremely unjustified.
That's often the case for companies that are run by families or by people who have helped create it or whatever. I mean, we've seen in other spaces as well, but like I've been saying, the oil sector is particularly bad. So Elliott Management is the hedge funds coming in, right? I mean, what do they want to do?
Well, they have 5 directors who, first of all, 4 of them have really in-depth industry experience. And one of the big problems at Hess is that they're just terrible at drilling, which is a real problem if you're an oil firm. So they spend about 30% more than the average in drilling US wells, and that amounts to billions of dollars of value destruction.
A point you made in a piece yesterday was that Hess kind of acts like it's a major 10, 15 times as big as it currently is in the amount of money it spends and the size of jobs it takes on, and then it doesn't really deliver.
Yeah, they own majority stakes in things, and the likes of Anadarko are quite shrewd about this. So they'll take on a big project, they'll go into something ambitious, but they'll bring lots of other people on board with them just to spread the risk. And as a result of Hess's rather too big for their boots strategy, they spend an awful lot on capex relative to their size, much more than anyone else does.
Right, so we've seen this kind of board revamp before. It's a start, but I mean, with Chesapeake's taking a long time, Sandridge taking a long time. These CEOs have quite a lot of clout, and it's not that easy to change them. How do you think that'll pan out?
Well, it'll just take some time, I think. I mean, it looks like, from what we've seen, Hess has already taken some other steps as well. Yesterday it announced it was selling off some old refineries or something. So by doing that, it's buying itself a bit of time, I suppose. And the stock was up 6-7% yesterday. It's been undervalued, as Chris was saying, for a while. All the analysts are saying, look, it should go up 15, 20, 25% from before these announcements. So they're buying themselves a bit of time. If the new board members come on, assuming that goes through properly, then the CEO gets a bit of a jolt. But it's basically his company. He's used to running it the way he wants.
He's a bigger shareholder than Elliott, too.
There you go. So they'll probably have fewer board seats under his control. So that in itself is a good thing. But as with most of these things, unless you get rid of the CEO, things don't necessarily change particularly quickly. But then again, I mean, Chris, you were talking about Sandridge last week, weren't you? And against Chesapeake, and how the two of them have come up with different ways of dealing with their recalcitrant CEOs. The
Chesapeake CEO is gradually backing off. It's a gradual retreat. He's been making lots of governance reforms. The CEO of Sandridge, Tom Ward, has just completely dug in his heels. And if anything, he's making the governance problems worse. He's changing the voting structure to make it harder to get rid of him.
Right. Okay. We'll leave it there. We'll see what happens with governance in this particular case on the oil patch, and we will have more breaking views tomorrow.